One of the big fears on the geopolitics is how quickly and how scarily, I suppose, this can turn into a broader regional conflict coming out of Israel and Hamas. Walk us through what effect that has on the global economy in the worst case scenario.
Yeah, clearly we don't have this as a baseline scenario for now, but clearly we can give a probability of 20% to this downside scenario. And clearly that would mean higher oil prices. That's the direct impact of this conflict. And we can expect oil prices to go up from $90 per barrel to $140 at a peak and even $120 on average next year. So clearly at these levels of energy prices, we understand that central banks would be much more into the wait-and-see mode before they cut interest rates. Obviously, inflation rates will be much higher. If we think about the US, it will reach 3% or more next year. So not going back to closer to the 2% that everybody is watching for. And if we think about Germany or the UK, it will be above 4%. So clearly at the global level, we can talk about an inflation at 5%. 1 percentage point above what we were expecting before the conflict or in a baseline scenario. So of course, this has an impact on growth. Today, we are anyway in a very low growth environment, borderline recession. We are not growing for 6 quarters in Europe. We are not growing for around 3 quarters in the US. So clearly that could shift us into the recession scenario that some would have expected anyhow in the baseline scenario. So overall, in this scenario, we would have global growth at 2% in 2024. So clearly that's half a point lower than in the baseline scenario. And we are getting closer to that threshold of the global economy switching to a broad-based recession. So clearly in this environment, it will be very tough for central banks to cut interest rates because they have been fighting for their credibility for so long. And probably they will start to envisage some very modest rate cuts at the end of next year if that materializes. But we have difficulties to see. In anyhow, in the baseline scenario, they will not really start to cut rates before the autumn next year already.
Yeah, and you're already seeing that priced into the markets, Anna, to your point, which brings me back to what you just said. We're seeing really this extremely slow growth for, I think you said 6 quarters in Europe. It's a similar story in the United States where you are seeing that deceleration. But something that Chair Powell said to me really, said, I should say to David Weston, our Bloomberg anchor, really stuck out to me in that he said the bond volatility that you are seeing right now has a lot to do with the resilience of the economy as opposed to Fed expectations in the long term. He's talking about 30-year maturities here. Anna, if we're talking about oil prices potentially crossing $100 a barrel on this conflict, how quickly does that turn inflation on its head?
Well, pass-through effects are slow. They are slow because, as you mentioned, there are still some resilience pockets in the economy. There is still some excess savings. There is still some excess cash on the company side, on the household side. The labor market is not crashing. So clearly, the pass-through would take between 3 to 6 months. And in any case, we are in the midst of the pass-through of the past rate hikes. Let's not forget that even if the Fed doesn't increase interest rates in November, we will still see the increase in interest rates into mid-2024 because nowadays, in this current cycle, we see that the transmission is between 12 to 18 months. So clearly, we have not yet reached the peak of the transmission of monetary policy. Now, of course, everybody's focused on the data as of today, but we are convinced that the data is going to decelerate even further, and the labor markets will continue to rebalance, and we start to see that already. So clearly, that's something that will bring a bit less of this hawkish in the bond yields market. But clearly, yeah, that is doing the job for the Fed. The investors are doing the job for the Fed. But one of the concerns of the economists, and we all remember it very well, is the remake of the 2012 sovereign crisis in Europe. And not only Europe, because even the US is very exposed to the increase in interest payments. And nobody actually, as governments, has clear plans in adjusting their public finances. And everybody tries to make it through into a fiscal slippage because everybody understands that the cost of doing that would be a clear-cut recession. But at the same time, the sovereign risks have increased. And that's a reality because real interest rates are clearly much, much higher than gross. And actually, they are at the highest level since
Anna,
the Great Financial Crisis.
Yeah, to your point, I've got to say you are 100% right on those fiscal worries that are starting to seep into the market. Sadly, we do have to leave it there.